Good afternoon, everyone, and welcome to the insurance panel at GTR Asia 2021. My name is Fabien Conderanne. I work at Willis Towers Watson, and as an insurance broker, I help our clients, which are banks, corporates, and traders, to purchase credit insurance or political risk insurance from insurers. We have a good panel today to discuss what is the current state of the insurance market with two insurers and one client in the panel. So thank you all for joining. We are live from Singapore and working from home for most of us, all of us, I think are more or less in that situation today. And since we are live, you might see my kids storming into the room anytime when they come back from school now. So we will see if that happens. Hopefully not. I've told them not to, but they don't always listen to what I say. So let's see if it happens. It also gives you the opportunity to ask questions to the panel members during the presentation. So as we go along, if you want to ask questions, please use the chat box, send difficult questions. It's part of the pleasure of the moderator to throw difficult questions at the panel members. So please bring them in. I think it's going to be interesting. When we did this presentation, I've done this for a number of years now. I look a little bit older every year. I dress less and less formally, as you can see. I have more and more facial hair. But what we've seen last year when we did the same panel is that the key word that came back all the time in our discussion was uncertainty. There was uncertainty around the credit environment that we were operating in 12 months ago. There was uncertainty on the COVID developments and how the crisis would unfold. There was uncertainty on the level of claims that it would have and the impact it would have on the insurance market. There was uncertainty on the level of origination that our clients would be able to continue to sustain in that credit environment. And what it would mean for the insurance market in general. So we are now 12 months later. We're going to look back at what we were thinking and try to see what has happened in the last 12 months. We're going to listen to what the panel members have to say about whether it was worse or better than what they were expecting. And it's going to be, and we're going to look forward as well to what is going to happen in the coming quarters and months. One thing that we will not be talking too much about in this panel, although I'm sure it might come up, is ESG. And there is a good reason for that. It's a theme that is very topical, and certainly we want to talk about it in the context of credit insurance. But we have done a dedicated case study that will be shown up right after this panel. So I encourage you to tune in to the discussion that will be streamed live after this panel discussion ends. My colleague Lee Garvey from Willis Towers Watson will interview Mathieu Lebret from Nord LB and Eugene Tan from Euler Hermes, specifically on green financing and on the impact and the support that insurance and private insurers can provide in these transactions, particularly on renewables. So please tune in for that. I think it's going to be exciting, and that's why maybe we'll touch a little bit less on ESG in this discussion. Now, we are a market with clients and underwriters, so let's get straight into it. I'll give a chance to the panel members to introduce themselves first, starting with the underwriters. So maybe Jaime Taylor, you can tell us a little bit more about you and Chaucer before we start.
Sure, thanks, Fabien. Hi, I'm Jaime, and I'm the class underwriter for Credit and Political Risk team at Chaucer Singapore. Chaucer Singapore is the Asia hub office representing Syndicate 1084 at Lloyd's of London. And it's my pleasure to be here to see you today.
Thank you, Jaime. Now I'll go over to Jamie Jeffers from Canopius. Jaime, I'll call you JJ because so as not to confuse everyone with two Jamies on the panel. But so JJ, over to you.
Thanks, Fabien. So I'm Jaime Jeffers, or JJ. For this discussion, I'm the head of credit and political risk for Canopius in Singapore. We established the book in January 2020, so excellent timing, just 1 month before COVID really hit Singapore. So this has basically been my office for the past 2 years. It's a pleasure to be here today and looking forward to the discussion.
Thank you so much for joining. And then now we'll switch to the client side. So we have Ashish Makhija from Standard Chartered Bank joining us this afternoon. Thank you, Ashish, for joining. And maybe you can tell us a little bit about yourself as well and your role within the bank.
Sure. Thanks, Fab. Hello, everyone. My name is Ashish. I've been with Standard Chartered now for the last 11 years, most of them within the credit insurance group. My role is to find insurance for our lending deals, from the plain vanilla ones to the more structured long-tenor ones as well, including for derivatives and other financial market products. And we mainly use insurance for distribution and capital management reasons.
Yeah, thanks, Ashish, and thank you for joining. I'm so glad that your name is not Jamie, because I was running out of ideas about how to deal with that Jamie situation. So thank you all for being here this afternoon. We're going to look at what has happened in the market in the last 12 years first. And maybe, JJ, I'll go to you first just to get a sense of what's the level of activity in the market that you've seen in terms of volume of new inquiries and business that you've done. Are you doing more this year than you did last year? I remember when we talked about this a year ago, and if you look at the MAS statistics, basically the premium in the market in 2020 dropped by 20% compared to 2019. And we had some carryover from previous years. So the level of new business initiated in 2020 probably dropped by 25 to 30% at least. Now, what has happened in 2021 so far for you? Are you seeing more business? Is that an active market for you?
Yeah, so look, we didn't really have a pre-COVID in Singapore. As I said, we established the book in January 2020. But I can take reference of obviously our much larger business in London, where Singapore is probably about 10 to 15% the size of the London book. So what we actually saw when COVID really hit in Feb, March, and there was a lot of uncertainty around the market, we did see a drop off in inquiries and a lot of drop off of support going into the market. And I think that just basically was from the uncertainty. At Canopius, we presented to our key stakeholders, our shareholders, and our board a drains up view of our book. And while there was a lot of trepidation going into that on their side of what might be in store for CPR and for our risk book, we actually came out of that meeting with a lot of confidence behind what we had written on our book and to grow, a mandate to grow going into 2020, 2021. So while there was a little bit of a blip, a lot of the continued support the government gave in the market meant that NPLs and banks were low. Claims across our industry, or particularly in what we look at, tended to be low. So we were actually able to continue to grow the book. So in 2020, we put about $350 million into the Singapore market worth of support. We're looking at probably growing that to about 500. So probably about a 20% increase, but from a zero base, we're really pleased with that. With regards to inquiries, we probably see between 3 and 5 inquiries a day. So anywhere between 1,000 to 1,200 a year. We probably put MBIs out and about somewhere about 150 to 200. And last year we bound maybe 25 transactions, and we'll look to bind maybe 40 this year. So the market has kind of been able to trade its way through COVID. It was very positive for 2021. 2022, there's probably still a little bit of trepidation that as government stimulus pulls away, what impact that will have for our market. But we still feel very positive about the market and our banking clients.
Yeah, good to hear that this has continued to increase in 2021. Jamie, do you see the same things at Chaucer in your books?
Yeah, pretty much. I think we've been here since 2007, so we do have a lot of basis to compare with. Generally, it does feel like there is an overall need and a very genuine want to do deals across all our risk partners. And I would say that definitely the volume of inquiries have gone back to pre-COVID levels, if not more. I think the main hurdle for everyone would be the sector-specific appetites for each one of us. And then shaping our appetite would, of course, be the global trends and the risks, which they are being discussed here at the conference. As per the various trade heads in the morning session yesterday, it definitely looks like it's getting quite busy for them too. So yeah, it's looking very, very positive for us in terms of volume and growth.
Excellent. Thank you both for the insurance perspective. I hope we're keeping you busy with our inquiries, and we'll keep them coming for the rest of the year. Actually, switching from the client standpoint, are you originating less or more transactions than pre-COVID levels at the moment, and particularly this year? And does insurance remain an attractive distribution channel for you guys?
Okay, so I'll answer this question in 3 parts. First, I'll talk about origination and how that has changed. Second, I'll talk about what we need insurance for in light of these changes. And finally, I'll talk about insurance, attractiveness of insurance as a distribution tool. So if you look at origination first, as of mid-September, according to D-Logic statistics, YTD loan volumes for Asia, excluding Japan, have increased 7% compared to YTD 2020. But at the same time, deal count has reduced by 13%. And these are numbers for mostly all regions across the board in Asia, excluding Japan. What this reflects is a concentration of risk theme and at the same time a flight to quality. Continuing with this flight to quality, understandably, pricing has also gone down for the top tier risks. At the same time, liquidity conditions continue to remain very strong, especially for these top tier risks. So what does this mean for us as a buyer of insurance? We have had to redefine for ourselves what we need insurance for in the current environment. So two main areas stand out. One, with the higher volumes, lower deal count, what this means is that we expect to take a higher hold in these deals. And that's where insurance can help us go a long way. They can be very useful partners for us. And this is a sweet spot for insurers as well, because these are the top tier investment grade, highly syndicated deals. But the issue is tight pricing. The second place where insurance can help us a lot in current times is if we want to provide meaningful line sizes to clients on the better paying, more structured deals. This is not such a sweet spot for insurers, but we do see strong support from quite a few insurers in this space as well. So that brings me to the third point, whether insurance is an attractive distribution tool. With regards to the above 2 points, on the first one, more than satisfied with how insurers have delivered. On the second point, quite satisfied, but I think the market can deepen with regards to the appetite for its most structured deals. Compared to other distribution tools, I am a strong proponent of insurance. That's why I've been doing this for the last 10 years. And I think most banks as well, in most banks, it is becoming a more and more important distribution tool. If you compare it with other distribution tool, it does have pros and cons. So for instance, if you compare it with the traditional funded distribution, obviously the con is it's not a funded mode of distribution. If you compare it to a CDS, there are more ongoing obligations that a bank has to comply with. But I would think that in current times where funding rates are not that high, insurance is quite an attractive tool from that perspective. And if you compare it with the CDS, the benefits that insurance has is that it is a proper bespoke tool with no basis risk. And the ongoing obligations that a bank has are not that strenuous. It is very much manageable. So we have increased our use of insurance, especially during these times, because if you look at CDS markets, for instance, they do react quite violently to market events. And that has another thing going in favor of insurance. It's a much more stable market when it comes to volatility and pricing and appetite compared to something like CDS. Also, one final point that I'll make on this front is in times like this, where all the banks are doing some scenarios around stress scenarios and to see what the portfolio would react in under doomsday kind of scenarios, having insurance provides a lot of comfort to my credit and portfolio management team. So it's one of the reasons why we are looking at insurance more and more, and I think the use will only grow.
Okay, yeah, I think you stressed a very important point in terms of the relationship aspect of the business, which is these are long-term relationships between the big purchasers such as Standard Chartered Bank and the underwriters, and building and these relationships are being tested in times like crises like the ones we've seen. So I think it's really interesting to hear that these are these relationships sustained at these times of these trying times, and that it goes through up and downs. Speaking of up and downs, I think it's fair to say the market has gone through several waves of up and downs in Asia. From the if you take it purely from the private insurance, credit insurance market standpoint, there was a wave of claims in 2015 and 16. Back 5 or 6 years ago, primarily in India and China. And then obviously last year, the well-documented fraud cases in Singapore, which have really tested the market again and had an impact on the wider market. Then if you look back 10 years, this market in Singapore had gone stronger and stronger with the introduction of more new players. And JJ, you're a good example of that, arriving with Canopius having a global business and having run that business from London for a long time, opening up in Singapore. We also have Argenta, Sompo International, other examples of underwriters that came during that period of time. But in the last 2 years, we've seen the market contract a little bit. We've seen some players exit the market. Aspen Insurance have decided to centralize their underwriting in London and close their Singapore and are closing their Singapore office. Zurich Insurance have decided to stop underwriting this class of business globally. So for the first time after a wave of expansion in the Singapore market, we've seen a contraction in the last 2 years in the context of COVID. Ashish, I'll stay with you for this one. Are you concerned by these developments? Do you still think we have a buoyant Asian credit insurance market? Do you still find the capacity that you need from a client standpoint?
Yes, I think these are bumps in the road, no doubt, and I do hope that other insurers make up for this loss as soon as possible. Insurance is a growing market and is already, I think, a decent sized market globally and especially in Singapore. Not as big as London, but quite big here as well. But we need it to become deeper. Loss of a player like Zurich and Aspen in Singapore is far from ideal. But I still think that the business potential is very strong in this part of the world, and there are enough supporters of the product like Jaime, Canopius and Chaucer, who can fill the gap that has been created. But the fact is that there have been some high-profile defaults, and these make the numbers not look so good. So we all need to think about what has led to this and what needs to be done differently. And I think all parties need to step up. So from banks' perspective, for instance, we need to realize that we live in a different world now. Governments like China are not hesitating to disrupt the markets. They're sending a message to lenders not to base lending decisions solely on the basis of state support. They're also working towards cooling overheated sectors. So in light of this, banks need to be more responsible on structures, covenants, checks and balances, and focus more on corporate governance. Brokers on their part, I think, need to work towards deepening buyer penetration, bring more volumes to the market, because that will act as buffer for these big losses. And in our business, we are in the business of taking risk. So losses are inevitable, but we need to create a strong buffer to withstand those losses. Insurers, I think, on their part, need to diversify. Diversification in itself is a risk mitigation. I think this will help increase the universe of deals that are insurable, provide everybody better premium rates, and make sure that they don't miss out on some great risks. So I think the market is strong, but these steps will help make it more resilient, which is necessary.
Okay. Yeah. Thanks, Ashish. I think I agree. We need to work harder. So I'll start immediately after this call. I promise. I'm going to go over to Jaime at Chaucer. From your standpoint, does that create an opportunity for you guys? The fact that certain players are exiting, is that going to improve your competitive position, or do you think it's just a minor event for the market? What's your view on this?
We actually do not think that the recent exits of some of our competitors actually mean anything negative about our market. That there's a lot of opportunities for profitable growth. And Chaucer, like I said just now, we've been here in Asia since 2007. I mean, for the past 14 years, we've been through the insurance cycles, we've witnessed entries, we've witnessed exits, we've moved offices several times, and we also paid some claims. So there's a reason why we are still here. I think it's a nice contrast between me and JJ, because Chaucer's been here for 14 years, and Canopius is like a lot of the other new players that you mentioned. I have only started shop in the last few years, but we all see the opportunity here. We all see the potential here, and that's why Chaucer is still here, and we intend to continue staying here to provide the support for our clients and hopefully take some advice from Ashish on diversification and making our business a lot more resilient. Our parent group is China Re, and they have been very supportive of both Chaucer Singapore and this specific class of insurance, which is CPRI, we shorten it as Credit Political Risk Insurance. And CPRI have been a very, very profitable area for Chaucer Group, regardless of claims activities in the past 5 to 7 years. So, we'll learn from any mistakes made, and we'll continue to refine our underwriting tools and guidelines, in order to move together with the wider market that we operate in.
Thanks, Jaime. JJ, you mentioned earlier that you opened at a very interesting time, right before COVID struck, and I'm assuming you did that when the decision was taken because you saw at the time Asia as a big opportunity. Do you still see Asia as a big opportunity today, 2 years on?
Absolutely. our approach in Canopius is maybe a little bit different to some others in the market. We very much have a hub and spoke approach where London acts as the hub, and we in Singapore or in APAC benefit from the economies of scale of the London book. So whether that be from an operational standpoint, claims, legal, which are all in-house for Canopius, we have those capabilities in London, and also from a reinsurance perspective. And what we try and do is we're trying to have specialists in regions that can leverage off the economies of scale that we have in the London market, but not try and squeeze the Asian market into London. So we believe in being in the region, and we believe in hiring what we feel are people who have skill sets that can meet the market. So even for myself, I'm 15 years a banker. I think I came across Ashish as a banker, as a broker, and now as an underwriter. And in London, we've got several bankers in the team. We've got several insurers in the team. So what we try to do is meet the market. The other thing with the hub and spoke approach as well is that we don't look at Singapore in singularity, or we don't look at the Asian market in singularity. So we write our business as a team, and if we have losses, we wear them as a team. So we don't see Singapore as a single entity. We see it as a part of a franchise. And for us, that means that we can, one, manage our cost base a lot better, but two, we feel like that we can diversify and meet the market and be a little bit more nimble, specifically for APAC. So we see great opportunity here to grow a book from zero to putting close to $300 million worth of risk into the market in our first year, 500 million in our second year. That's nearly $1 billion worth of risk into the market in 2 years, with just one person in APAC is testament to that. So we definitely think that there's more opportunity in the market. The buyers in this market are still still a relatively small subset. SCB have been in the market for a very long time, but we're not seeing the regional banks buying our product. That's something that we all need to work on, because we do need more depth in this market. Absolutely. While we have 50 or 60 players in the credit market, between London, Singapore, and the US, our appetites can be very narrow, and we can look at different parts of the market. So I think Ashish is right. I think that we need a little bit more depth in the market. I don't like to see anyone leaving the market. There's plenty of capacity to go around, and we think that there's a lot more risk that can come into this market, because we firmly believe that insurance, as the product as it is now, and the innovations that are coming up in insurance, is going to be something that's going to be very powerful for insurance companies and clients alike.
Okay, thanks, JJ. Since I have a follow-up question from the audience that came through, so I'm gonna throw it here quickly, because it's precisely on what we're just talking about. Do you think that any potential new markets will appear in the coming year? We were talking about the exit of a couple, but do you think there will be new markets coming in the next couple of years? JJ.
I'm not sure. It's an interesting. So CPR is an interesting subset of so we said the wider trade credit market. A lot of the larger, more general insurers just find the kind of nuances to the business kind of difficult to kind of amalgamate into their wider business. So it does tend to suit specialist insurers like ourselves and Chaucer, and some other players in the market. So not so sure, but hopefully, I think a lot of the underwriters out here had a very strong 2021, and are looking fairly strong for 2022. And as those results feed back into the market and as loss ratios get realized, I think that, particularly insurance companies that have a presence out here, we don't think that it's a massive investment to bring, a specialized person in and have a kind of a hub and spoke model. So yeah, we think the opportunity is there, and we'd love to see other insurers making the dive into the market. And what we'd also love to see is, particularly from our broking partners, is to try and bring more new banks into the market so that we can get a lot more depth there.
Yeah, no, that's a good point, and I'm with you on this one. I think we will see most likely new players entering this market, because it's an attractive long-term market to be in Asia. So I do believe that we will see more new entrants in the 12 to 24 months to come, when things continue to stabilize. I'd like to switch maybe now topic and talk a little bit about claims, because last year in our panel we had a loss adjuster, because the claims topic was really at the center of everyone's minds, and we were just going through a wave of or a series of fraud cases that had a big impact on the market. and everybody was wondering, will claims get paid? Will there be more claims on the horizon that we don't know about yet? What is going to happen from a claim standpoint? So JJ, I'll stay with you on this one. Of course, you have, as you explained, a very recent book in Asia. But what's been your claims experience so far? More importantly, what do you think is going to be the likely claims impact in the coming 12 months?
Yeah, thanks, Fabien. You look, benign is probably our what's happened with claims. Luckily in the past couple of years, whether by design or luck, we haven't had any major claims across our book, and we don't really have any significant what we would term as wobble. So we're very confident in our portfolio in both London and Singapore. One of the, I suppose, again, by luck or design, some of the sectors that we just don't specialize in, and this is pre-COVID, this wasn't because of COVID, is aviation finance. We're not really in aviation finance. We're not in tourism and leisure, and we're not really in property. So a lot of the industries that we were involved in were particularly resilient. Now, in saying that, there's been a huge amount of government stimulus that's come into the market, and there's also a lot of cheap capital, as Ashish alluded to earlier. The liquidity markets are still extremely strong, and pricing is very tight. Is risk getting priced appropriately? I'm not too sure. So I think probably looking into 2022, 2021, I think there was a feeling that maybe with some of the stimulus being retracted, that we would start seeing an uptick in claims, or at least the NPLs in the major banks. That hasn't seemed to happen in 2021 because the stimulus has continued. I think probably in 2022 we will start to see some claims maybe come into the market. But in saying that, we also have to look at the performance of some companies. So let's take Qantas, for example. I was a banker in Australia for nearly 13 years, and Qantas, obviously a name that everyone knows. The way in which they were able to manage their business throughout COVID is nothing short of amazing. They're a company that are extremely well supported in the banking market and in the insurance market. They had to furlough pretty much all of their staff. They had to basically stop a cash drain by a factor of like 90%. And they were able to do that. And they've just launched international flights again, and they've been doing some domestic flights throughout COVID. So I think we also have to remember that a lot of the companies that we do support, we support strong balance sheets, we support strong management teams. And I know SCB will be very similar in a lot of our banking clients. So while there might be some stimulus that might be removed, and maybe there mightn't be an uptick in some of the sectors that they might be expecting, we still think that a lot of our clients are very, very strong and well placed and well supported to look into 2022 and beyond.
Jaime, I'd like to go to you now. Your book obviously has a little bit more history, legacy in Singapore. So what's been your claims experience in the last 12 months, and where do you think we're heading to for the next 12 months?
Yeah, I mean, we had a few notifications, but it was benign is probably not the word I would use that JJ was using just now, but it wasn't disastrous. And kind of leading on from what JJ was saying earlier on as well, Chaucer operates under the same model where it's very much a global business, and globally the book is still profitable despite the notifications that we've had in the last few years. And like most of our peers, Chaucer included a COVID load in our claims reserves. So we were bracing ourselves for subsequent waves of notifications. And thankfully for everyone, the can kept being kicked down the road as governments around the world stepped in to offer support. And although I think the can is a little bit smaller now after all that kicking down the road, but we are keeping the COVID load in because there's still uncertainties that we are not so sure of. I mean, as per the Lloyd's Emerging Risk Report that was launched a couple of months ago, the sovereign debt crisis is a possibility still. Given the burden that the governments have been carrying due to the pandemic, the stimulus that's been given, as what was mentioned just now, there is it's a real kind of risk of, I won't say to the extent of sovereign default, but with interest rates going up, with quantitative easing tapering off, investment leaving emerging markets, and commodity prices are all over the place now post Evergrande. So these are lots of things that still keep us up at night. And it sounds a bit depressing, which is why we're still keeping the COVID load in, because for insurers, we have to be prudent. It made me smile just now when Gigi said that, 2022, we think it might still happen, because every year we're thinking it's going to happen, it's going to happen. I think it's prudent for us to keep that in mind, but at the same time, still look for opportunities to help with recovery really globally, and support the governments and support our clients where we can.
Yeah, thanks. And just to add to what you were both saying, I know we have a lot of people looking at trade finance and receivables in this conference. If you look at the accounts or the financial statements of the listed entities, the listed credit insurers like Atradius or Coface, Euler is also listed through Allianz. They have published very, very low loss ratios for the trade credit part, so the short-term receivables part. Their loss ratios for 9 months 2021 are at 25%. So for every dollar of premium that they've received, they've only incurred 25 cents as a cost of losses. This is very low for trade credit. Usually the average is 50 to 60% across the cycle. So it's twice less than the average for 2021. And I think you've described it perfectly. We're in that situation where scenario A, the economy needs stimulus and needs supporting, and the governments will do it. Scenario B, the governments withdraw only because there is enough for the economy to stand on its own feet, and the support is not needed any longer. The nightmare scenario would be if the governments withdraw their support and the economy is not strong enough, but that doesn't seem to be, governments do not seem to be willing to do that because the cost would be probably too high. Now, switching maybe to you, Ashish, and from your bank standpoint, we've heard from Jaime that the environment was benign. The stats from trade credit insurers also show pretty low level of insolvencies. Is that illustrative of what the banking world sees? Are you experiencing low NPLs, low losses in your bank books as well?
Yep. Yeah, like most banks had quite a rough 2020, and things have improved quite significantly in 2021. Maybe faster than most people expected it to happen last year. But we definitely aren't out of the woods yet. For Stanchart, in the Q3 financials this year, our provisions dropped to 107 million, significantly down from the 350 million number last year. But this figure was still double what analysts estimated. So we're still not out of the woods, I'd say. Of the specific insured portfolio, I can think of only one deal during this entire period where its stress started mainly due to external factors and where we needed to file a claim. So it's not been as bad as one expected in a way, but I would say that the pain has been consistent throughout, right? There are some COVID resilient sectors that have done well, and that I think will continue to do well in 2022 and beyond as well. The likes of digital, tech, warehousing, and logistics. Commodities, yes, the prices are all over the place, but they have bounced back after a significant blip last year. Energies are also doing quite strong now. Sectors that have suffered the most are the ones that are entirely dependent of movement of people. Leisure, retail, aviation, hospitality. These are sectors I don't think we know the extent of NPLs yet, and it will take quite long, in my view, for things to get back to normal and for us to have clarity on this. And that is still assuming that there isn't another COVID wave, hopefully.
Yeah, thanks, Ashish. I'll stay with you for a minute on claims, because one of the perennial topics of discussion in these panels is whether claims get paid by insurers. And we as brokers have a good observation deck where we can see the traffic of claims. We have dedicated teams who are helping our clients to collect the claims when they happen. What's your experience when you've had claims? Have you collected them? Have you been happy with the experience? Has that been as straightforward as it should?
Yep. Yeah, very happy. Whatever claim we've had have been paid on time, in full, without disputes. Time and again, insurers have proved that this product works and that they're genuine risk partners. So very satisfied as a client as to how it works. However, I can understand why this still seems a little intimidating to new buyers, so people who are not exposed to the process. For example, I wonder if the ongoing obligations, though not complicated at all, can they be simplified even more, make everyone's life simpler? Another example is loss adjusters. The term in the process can create an impression that insurers are trying to adjust or avoid a claim, which is obviously not the case at all. I know now that this is more like an outsourced process. However, I do think that it can be maybe made a little more efficient and easier for the insureds by introducing more guidelines around this process. But if you look at whatever experience has been so far, it's been absolutely smooth. And internally as well, we managed to convert even the doubters into believers.
Excellent. That's great to hear, because obviously we call the claim process the moment of truth under the contract, right? You want to make sure that whatever coverage you've purchased is actually effective when you need it. So it's really good to hear. We're going to talk now about credit appetite and start looking a little bit forward about where we think the economy is going and where insurers want to focus their portfolios. So maybe, Jaime, I'll start with you. We've seen that obviously insurers in general have been a lot more conservative in their underwriting due to the uncertainty that I was mentioning earlier. And the attitude has been a flight to quality. I think it's been mentioned a couple of times to try and underwrite better rated names and to focus on higher visibility, probably larger risks, as opposed to taking more lower risk or higher risk, names. So what's been your approach, and how do you see that going forward in terms of credit appetite?
Yeah, I mean, like a lot of people here, like a lot of insurers here, I think, Chaucer, we reviewed our underwriting strategies and we reduced our exposure on certain sectors, including, the names that the sectors that we keep talking about: aviation, tourism, real estate. These strategies still remain as we try to expand our offerings instead to keep up with what has been more successful. So logistics, data centers, healthcare, these are pandemic resilient areas that are doing well and still receiving lots of attention and lots of funding from all our partners. And as alluded to earlier on, because some clients may start looking at their overall exposure to certain systemically important multinationals and even sovereign names as part of kind of portfolio management. So these are names that historically and typically might not make it to the insurers because they are such high quality names that the banks do not require any relief or capital relief for. But as we talked about earlier, as sovereigns continue carrying on the debt, banks also need to be prudent in managing their overall portfolio exposure. And insurance becomes a nice kind of discreet and non-competitive partner to help with the overall exposure management. And so we start seeing some of these and we do welcome them because we still believe that systemically important multinationals, although they are now at a higher risk of being exposed to some of the volatility in supply chain issues. But we still think that they are names that will be here and that we should be supporting. So these are the areas I think that Chaucer has kind of pivoted to while kind of reducing exposure to some of the other sectors that we feel are still a little bit unstable at the moment.
Okay, thanks, Jaime. That's really interesting to see how your underwriting evolves with the situation and over time. JJ, I'd like to ask you the same question. Obviously, each insurer has their own sweet spot and the kind of deals that they like, or structures that they like, or sectors that they like. Where do you want to focus your book?
So for us, it's to meet the client's need. So sitting with the banks, sitting with people like Ashish and some of his peers in the region and globally, and find out where the pinch points are. So what we've been doing is expanding our appetite to make sure that we're meeting the bankers' requirements of how they can use insurance. So in the past 24 months, new products to Canopius would be leverage finance. We've done quite a few leverage finance transactions here locally as well. Our derivatives play has increased quite a bit, managing and helping to manage our counterparts' derivative exposure. We've looked at CLOs and successfully closed a few transactions. Subscription finance, we've done a few locally and obviously globally as well, and different types of fund financing structures. So basically what we're doing is we're sitting with our banking clients, we're sitting with our brokers and saying, where are your pinch points? Where is, particularly from a capital point of view, where are you really getting squeezed on capital, and how can we help? And we found that, that's been a major area of growth for us in the past 24 months, particularly in the London book, but more so here in the Singapore book.
Okay, yeah, I'm with you on that. I think I can testify that I've seen one of the strengths of this private insurance market to adapt to new products and to the needs of their clients. And we've seen it time and time again with teachings and exchange of information that happens between the clients and the underwriters. There is a strong willingness from insurers to sit down with deal teams, learn about what they do, learn about the dynamics in their markets, and try to support as much as possible. So that's always been a strength of the market, which we should cherish and try to continue to develop. Ashish, from your standpoint, are there areas in the market where insurers could do better, where they can still support more? What do you think?
Yep. Let me talk about the good first, and then I'll conclude with a short wish list. So even in current times, insurers have been very sensible. Take commodities, for instance. It could be very easy for insurers to just walk away from that and not do it, given the number of other opportunities that they're seeing. But I see good appetite for the tier one players, which is the right call from a credit perspective, but it's a very sensible thing for insurers to do as well, which they could have kind of walked away from. Even for aviation, quite a few insurers are back to doing senior secured aviation financing deals. Another positive about all of this has been that insurers have been forced to think about diversification. This is because they need to be more selective now in the commodities, trade, supply chain finance, aviation, and sovereign and SOE spaces, which were bread and butter for quite a few insurers earlier. So I'm seeing more openness towards swaps, acquisition finance deals. We are definitely doing more long-tenor project finance deals and also seeing more interest for shipping finance. So all of this, I think, is excellent. When you talk of my wish list, firstly, I think we definitely need a deeper market for the more structured financings. So when you talk of leverage finance, equity-backed financing, fund financings, portfolios, funded solutions, there's so much more that can be done there. Insurers, to be fair to them, have kind of been trying to do these, and as JJ referred to earlier, we've seen strong growth in the subscription finance phase, fund finance space, and even CLOs and securitization. So it is on the right path. Secondly, I think that insurers should. I would like them to become a little more nuanced and discriminatory. Not saying that they aren't right now, but need more of that. So, for instance, we wouldn't support every equity-backed financing deal because banks also are wary of the MTM nature of the security. But for the right deals, this is a good opportunity to earn more. Obviously, we need to be very selective and pay even more attention to the basics. So who the sponsors are, length of relationship with them, corporate governance, covenants, which can help us identify warning signals early, deal security structure, which can help us have leverage over the sponsors. And insurers need to kind of give more importance, I think, to these kind of softer factors as well. Also, differentiating banks according to expertise is important. So, for instance, I would hope and expect insurers support us for very challenging deals in geographies like India, potentially even the ones that are out of scope for them. But I wouldn't ask them to do the same for us in Latin America, for instance, because different banks have different expertise in different geographies and different sectors. So I think that's another point where the market can do more, be a little more nuanced and discriminatory between different buyers according to their expertise in geographies and sectors. Yeah, that's it. I don't ask for much.
Yeah, it's Christmas is coming soon, so we should make that list happen as much as we can. Look, we only have 1 minute left, so I'll just try and cover a quick question from the audience. I'll direct this one to you, Jaime, maybe. Automatic underwriting, is that going to be a thing? Are we going to see more robots doing underwriting? What do you think?
I hope not, because that means I'll be out of the job. And, definitely do not want that. I mean, I think this sort of underwriting, it can be done for certain types of insurance. They're a little bit simpler. But I like to think that our class of business or the type of products that we do is a lot more, it's structured, it's complex. It requires a lot more contemplation, I think, than as good as artificial intelligence have been. I still would like to think that the human element plays strong role in this type of business. So not in CPRI, I don't think, but certainly for other classes of business, maybe.
Yeah, no, I think you made good points. What we might see in the future is a bit more fluidity in the exchange of information. We are still probably like the syndication market, not very efficient at circulating information between underwriters, clients, and brokers. So maybe we'll see that happening, but automatic underwriting is a different topic, particularly for large ticket items. All right, we're coming to the end of this session. We are running out of time, so I'd like to thank the panel members. Thank you so much to Jaime, JJ, Ashish for participating this afternoon. I encourage all of you guys to listen to the ESG. We have a few questions on ESG in the chat, which I couldn't take. So we have an ESG case study just coming up after this session. So please tune in with NordLB and Euler Hermes, my colleague from Willis Towers Watson. Lee Garvey will be doing that. So please join in for that. If you have any questions, please feel free to chat with us in the GTR platform tool. It's a great tool to interact. So we'll be happy to do that or over email. Thank you so much for your attention, and we'll be catching up soon. Thank you. Bye.